In today's video, we are going to look at a fun case study. This is actually based on a business owner in his mid-30s who was doing his research around high cash value life insurance, was interested in a policy, and we went through a lot. So what we're going to go through in this video is really the steps that we went through, the questions he asked, some of the main points of awareness we brought up that a lot of people ask really with any size policy. His policy size, he had originally wanted to see different samples, different options with funding a policy anywhere between $300,000 and $500,000 per year. So up to $500,000 per year. That's a significant amount of money going into a policy, which he does own a business, does well from a financial standpoint. So it's based on what his situation and his means. That's very, very realistic, and that is his goal. However, because the dollar amount was very, very large, he had a lot of questions. And so did his CFO as well, which is actually very valuable to have on a call. So he had an advisor really asking detailed, to-the-point questions to really ensure that the product was set up in his client's best interest. So let's get on into it and have some fun. We're going to go through a couple steps here that we walked through with him. Step number one was the design of the policy. So the design, he was interested in annual funding anywhere between $300,000 and $500,000 per year. Now, when we first looked at different options, we had considered scenarios with MassMutual and Guardian. We looked at a number of products with both Mass and Guardian. And really, as we went through everything, he eventually settled on Guardian. And the main reason why, two reasons. One, he loved their PUA flexibility. So Guardian is a company that will allow him to commit to a minimal amount and just dump excess funds into PUAs at his discretion. So he liked that additional PUA flexibility for his circumstances. He was attracted to it. And then number two, he really liked the idea of aggressively funding a policy between 5 and 7 years and then stopping, or if he continues to pay, just a reduced amount from that point forward. But as a business owner, I've seen this with a lot of business owners, he liked it, and a lot of people we talk to like this, is the idea of aggressively funding a policy and then paying a reduced amount or just stopping altogether. One, it maximizes the internal rate of return, which a lot of people like that. But then two, it's almost as if I have this high yield savings account that just continues to grow over time, and I can access it like a personal line of credit without having to pay anything in. I've noticed a lot of business owners like that over the years, and I like it too, frankly. But as we looked at the different options, so he eventually settled on Guardian and picked the higher end option, where he's got the ability to go up to $500,000 per year. Now, what we're not going to show in this video, but I want to touch on this, is whenever we're looking at scenarios somewhere between this range, is I really want to go through with you, if you're looking at a policy, what does it look like if you pick the $500,000 option, but only get a maximum of $300,000 per year into the policy? How much does that negatively impact you? Because if you pick the $500K option, and you only go with $300K per year, that's what you actually get into the policy. And we could rewind the clocks, go back in time and say, hey, I should have went with a $300,000 option. What would it have looked like? So what we like to show in a case like that is here's a policy with a $300K per year max. Then here's a policy with a $500K per year max. And what does it look like when I pay $300K into this option? $300K into the option where I can go up to $500K, so I'm not fully optimizing it. And then, of course, if I do pay $500K into this same $500K option, meaning if I bite off more than I can chew, how much does it hurt me? But that is something we looked at, and I'm not going to go through all those scenarios in this video, otherwise it'll be too long. We do have some content that specifically goes through those types of scenarios. You can see, check out a video up here. So with the design, what he looked at here is we settled on a policy where he's got a maximum of $500,000 per year. So the ability to pay up to $500K, and I keep saying the word ability because that is not what he's committed to. His minimum premium is not $50,000, which with a traditional product, it would be $50,000. His minimum premium is $100,000. And the reason why is the product that we selected as we looked at different options is referred to as this is Guardian's Executive Strategies Whole Life. So this product has a minimum base premium requirement of $100,000 per year, unless multiple policies are being purchased for a company. But in this case, he's looking at one policy just for himself, which Guardian does have a minimum premium requirement of $100,000. So this certainly disqualifies a lot of people from this type of policy, where it makes it where it's not even an option. Now, if he is going to pay in, call it a maximum of $300,000 per year, this product will not make the most sense. If we compare this to an L95 or different options, it would still make sense to go with a policy if I'm paying in $300K per year to have a minimum premium of $30,000, the ability to go up to $300,000. However, with that threshold of $500,000 and his age played a significant role in here in this particular case because he's younger. Those costs are not that high. A premium of $100K with paying up to $500,000 per year still performed quite nicely, and it is due to this particular product. This product gives you in the first year 95% of the premium in cash value. So this is a very cash-rich product immediately on day one. And a nice thing about it too, it is a high early cash value product type where it gives you more upfront. But because of the high premium requirement, you don't sacrifice that much long-term. So it's a nice option for people that are looking at this as an asset on the company's balance sheet, or if we're looking at it as an individual and we're paying a significant dollar amount into a policy. If you're watching this video and thinking, hey, I don't have $500,000 per year to pay into a policy, you can do this. Mass Mutual has a similar product that's available to everyone of any dollar level. It could be $5,000 per year. It is referred to as their high early cash value product. That could be $5K, could be $500K as well. But it's a product that will look similar to the example you see in this video. Not quite the same, but very, very similar, just with a lower threshold. I don't have to have a huge amount of money for it to work. So point here, $500K max. The product we looked at, or settled on if you want to call it that, is Guardian's Executive Strategies Whole Life Insurance product. 95% of the base premium that shows up in cash value in the first year, and then adding PUAs on top of it. So we're going to go through the actual design. Before we do that though, very important piece we've got to hit on here is the actual growth. So Guardian's dividend interest rate right now is what? This is a point I'll mention to everyone as it's so important, and I never want to assume people just know it from looking at the actual illustration. Guardian's dividend interest rate is 5.65%. The guaranteed rate with this particular product is at 3%, so that's the floor. That is not what he's actually earning on his money. What we want to look at here is the net internal rate of return, because anytime we see that dividend rate, or guaranteed rate for that matter, that is always a gross rate that is applied to the policy after the company's insurance expenses, mortality charges, everything that comes with the actual life insurance product. So, because this is not what he's actually earning on his money, and he's interested in, hey, what's the net internal rate of return? What's the net cash value growth? Simply, if I've got $100,000 this year, and it grows to 105 next year, that means I earn 5%. Like, what's the net growth rate? That's all I want to know. So the IRR will show us that. And IRR, that is the terminology that an insurance company will use as well. So if you're speaking with the life insurance agent, or if you see the internal rate of return on an illustration, this is what the industry uses really to display the net growth rate year over year. So we're going to look at the actual growth rate based on both the dividend rate and the guaranteed rate. We're going to look at an indexed rider as well. But my point is, you'll see gross crediting rates, but then the net growth rate year over year. And then what we looked at here is what if scenarios, meaning what does it look like if I go with this policy where I can go up to $500,000 per year. We're going to show you exactly what he settled on in terms of a plan, but then what's it look like if I pay in different dollar amounts? A lot of times people have questions. If you said, hey, I want the ability to pay this much money in, and we show you illustrations showing paying that much in, look fantastic. Oh, look at this cash value grow over time. However, what's it look like if life happens and I don't get the dollar amount in that I thought I could? Oh, well, now it doesn't look as good. Good to see that up front as opposed to dedicating money to a product and then finding out after the fact, right? We don't want a got you there situation. So we will go over those what if scenarios. Then we'll look at the final design as far as what he plans on moving forward with. And then also how he is going to be using the policy, real estate and business, loans, specifically how they work. What he likes more is our cash value collateral loans, which is leveraging a bank and a line of credit. What's the impact on the policy? And here's the big one, net growth rate on the policy versus net cost to borrow. This is very important, especially with folks we work with that are big into numbers. Like the numbers have to be transparent here. Don't try and sell me with some trick stating that I'm earning a dividend of 6% on my policy and I'm only paying 4% and I have a 2% spread. Like, no, that's not. If you try doing that stuff, people get really, really upset. What's the net growth rate, the IRR, compared to the net cost to borrow? I need transparency there. Let's take a look here. So what we will begin with are the different assumptions. So we've got a lot up here. Let's start with just the guarantees, just to make it very, very simple. So as we look at this, that's better. As we look at the left, what do we notice here? Guaranteed rate at 3%. Absolute worst case scenario here. If this is you, are you actually earning 3% on your money? Because your contract will state you have a minimum guaranteed cash value interest rate of 3%. No, you're not earning 3%. That's not what the net results come out to. So breakdown as to where the money is going. Here's his base premium, $100,000 per year. That's the required minimum, but you see a lot of it show up in cash value in the first year. Here's his net out of pocket annually, $500K per year. And these assumptions, we looked at a 7-pay. A 7-pay, funding up to the MEC limit for 7 years, and then shutting it down with a reduced paid up, will maximize the internal rate of return. So we looked at this scenario or that scenario for these options. But guaranteed rate, so that's my gross rate. What am I actually earning? Annual IRR. This isolates what the policy is growing by year over year. Average internal rate of return will highlight what the average IRR is over a certain number of years. For example, what did I average out over the past 10 years, 20 years? 30 years. That's what the average IRR indicates. You'll notice that the average IRR is actually in the red until we hit that break-even point when you see these numbers highlighted in yellow. The reason why is because once you break even, meaning you have more money in cash value than what you've paid into the policy, at that point in time, you've got a positive average internal rate of return. So again, this is worst case scenario here with the guarantees. Continue on here. Year 1, 500 in. Year 1 cash value, 461 and change. Negative hit of 7.66%. Now, if it was just the base premium, you would actually see a negative hit of about 5%. We've got PUA rider fees. We've got the cost of term insurance, which is why things are pulled down a little bit here. Death benefit, $16 million. That gives him a MEC limit of more than 500K. We overinflated this one a little bit because he does want the option to continue to pay into it beyond 7 years. And with Guardian's term rider, it really guarantees we can max fund it for 7 years, just based on what they allow. But death benefit was based on the MEC limit. Next year, pays in 500K, grows from 461 to 909. If you got the full 500K back, it would be 961. That's why we see an annual IRR of negative 5.4% that year. And what happens as it continues to make payments for the first 6 years, and this is based on the guarantees, so this is the guaranteed rate, and the guaranteed values also assume that the company's charging the maximum allowable rate for their term insurance riders, so it's a worst case scenario. But based on that, we see the policy actually produce a positive IRR in year 7, meaning he pays in 500 in year 7. It was 2.8, and now it's 3.3 plus a couple grand, plus $6,000. So that 0.18 is a representation of, call it, the $6,000 gain in that particular year. So guarantees, not that attractive, not earning 3%. When we look at it, the annual IRR will top out a little over 2.5%. We see it top out when he's about 50 years old in this example at 2.57%. And then the average IRR, I've got to make up for the negative years, so that tops out at just about 2% in this example. So that's absolute worst case scenario. We have seen these products with the major mutual companies do better than that, and they've been performing closer to the non-guarantees. But it's good to look at this stuff. This way I've just got transparency up front. Let's look at the other stuff, or the other assumptions. Dividend rate. So Guardian's dividend rate has been 5.65% for the past 3 consecutive years. And the 2 years before that, it was 5.85%. Base premium, 100K, 500K in, cash value, 461, IRR. The first year, you'll notice this with all Guardian policies, the guaranteed and non-guaranteed values will be identical. Beginning the second year, when dividends are applied at the end of each policy year, here's 500K in. Cash value grew from 461 to 942. I did not get the full 500K back, which gave me an internal rate of return of negative 2.05%. Worst year is the first year. Second year, getting better, but I've paid in $1 million and I've got 942. So my effective cost, if you want to look at it this way, just about 60 grand. That's how much I'm in the hole. By year 3, pays in another 500. I'm positive here on an annual basis, meaning I'm getting more back than what I'm paying in this particular year. Between years 4 and 5, I break even. This is cash rich from day one. Like why corporations, it's really a corporate product, executive strategies. You can see it in the name. Corporations like it because when they take policies out on their executives, the company owns the product, the cash value is an asset on the balance sheet, and this minimizes that negative hit. Individuals can't attain it at higher dollar amounts like what we see here, breaking even early. It takes away the biggest objection when it comes to cash value sales with whole life insurance, which is the upfront hit, which we're reducing that as much as we can here. And then by year 7, annual IRR 306, average 152. Then it jumps year 7 to 8. The reason why is because we eliminated the premium altogether through a reduced paid up option in this example. That kills the premium. He cannot pay anything in anymore. Also eliminates the term rider. Cuts the drag is how I like to refer to it. But it boosts the cash value performance. Now this is something that he did not decide on. He might want to continue to add funds. However, it is not something that we have to decide on when we first start the policy. We'll design it where we can easily flip this switch if we want to when year 8 comes or at any point in time after that. However, here's what it looks like, what it would look like if we do exercise that. Net annual IRR, the net average IRR, assuming the dividend rate never changes. And then we've got that indexed rider, which if you're not familiar with that, I would just type in index on our YouTube channel and you'll see some videos that go through Guardian's indexed rider. It allows you to tie your cash value in a policy to the S&P 500 index and grants a little bit greater earning potential on the product. There is a fee on the years we exercise it, so we do want awareness on that. But if I attach it to my policy and never use it, there's no charge. And you can go back and forth as time passes between the dividend and index. You can go 50-50, 70-30. You can really do whatever you'd want. So you do have some flexibility there, which is nice. And of course, it does really give you a lot more earning potential on a product, but that's all potential, right? Because it's the S&P 500 and all hypothetical. But first thing there that we just hit on, actual growth. So we designed with a $100,000 base premium because that's the minimum with this product. Actual growth. Just covered that. What if I go with this 500K option and I'm not able to get the 500K in? So here we've got the actual setup. What his policy will actually look like, and the same would be true if he selected the option with a $50,000 minimum. So we showed that as well in addition to a couple more options. But here, A big reason why he liked Guardian here is because he can target a $500K payment per year, but this is very, very important to him. Flexibility. He's not obligated to pay $500,000 per year. Base premium, $100K per year. PUA rider, $5,000 per year. We're not going to pull up the full illustration in this video, but that $5,000 PUA rider satisfies the term rider cost. So that OYT here, our 1-year term rider that's attached, I've got a whole life death benefit plus term, which is what gives me that $16 million. The 5K PUA satisfies that no problem here. So his total minimum commitment here, his true out of pocket, is $105. And that can be paid annually. It can also be paid monthly if he wants. So he does not have to pay that every year. I mean, he doesn't have to pay it annually every year. He can break it up over 12 months. But here's what it looks like if he pays just the minimum. So 105 goes in, and look at this. And this is really, it's this Executive Strategies product that's giving him this. 100 goes in, he's got 96,000 immediately. Like that's the first year cash value if he doesn't add additional funds into PUAs. Break-even point, however, so this product's great up front, but when we look at it, if we pay just the minimum, still takes between 9 and 10 years to break even, which we can get this between 8 and 9 if we cut the term rider after year 7. Won't make a huge difference, but we would do that if we're in a case like that where it's just paying the minimum. But if we just pay the minimum, this product wouldn't make sense. If someone's paying $100K per year in, makes sense to go with a different product with a $10K base premium in order to maximize cash value and flexibility. So this is just the minimum indefinitely. We can scroll down here. There we go. It does accrue over time, which is great. And eventually that death benefit increases. It's payable until age 90, but that's just the minimum. Let's take a look at some what-if scenarios. So here, the one on the far right, I'm going to get rid of that. The far right was what we already looked at. Here's the same policy. He can go up to $500K per year, but he's paying in $300K per year. And what I aimed for in this particular example was getting the same $3.5 million into the policy, but over a longer period of time. So same $100K per year going in, and now adding additional funds into PUAs. An additional $200K per year. And then at year 12, when he's 45 years old, another $100K. So he can do it however he wants, and we track this performance over time. But here's my total payments. Break-even point between years 5 and 6. So with the max fund example, let's go back to that. It was between years 4 and 5. So if we bite off more than we can chew and underfund it initially and never hit 500K, what's the actual impact here? If you're in a situation similar to this, maybe it's the same dollar amount, larger, smaller, whatever. Well, here we see the break-even points delayed by about a year. The average IRR will be a little bit weaker when we look at that, but just things like this are good to see up front. This way he knows, okay, do I still want to go with the 500K option? And an option we don't have here is one we looked at where if he gets 500K in really the first year, especially years 1 and 2, he breaks even between 4 and 5. Like if he's able to max fund it up front, if you're able to do that with a whole life insurance policy, stuff it, 10xing the base premium in the first and second year, it's going to look good and hit that break even when you want in most scenarios. And then we've got the planned funding here. And this is with all values again. Let me just do this real quick. Just look at the dividends here. This will be easier. So here, just dividend values is what he actually settled on. So this is identical to the 7-year funding scenario, where he stops funding altogether after year 7. But the difference here is that he keeps paying in the 100K premium. We see a slight drop in death benefit there. All we did was remove the remaining term insurance from the policy. And there's his IRRs, annual and average. We can see what this looks like based on the guaranteed values and that indexed rider, if we like to look at that. The guarantees is what most people like to look at, or a worst case scenario. It gets a total of $6 million in guaranteed to have $8 million plus a death benefit. It's always done better than the guarantees. Based on the present dividend values, that looks attractive. And we can run a conservative dividend, but I've been more than happy with the performance I've seen from Guardian. Historical policies before my time, and then also the policies we've been putting in place, they've delivered. Same is true of all the major mutuals when I look at well-designed policies with them. So this was his actual plan here, or is his actual plan. So we've got the what if, and then the final design, 500K years 1 through 7, and then 100K thereafter, and then using the policy. How do loans work? So we've got a lot here. Let's walk through exactly what we walked through with him. So first we looked at direct policy loans. And this is a newer Guardian policy with a 5% fixed loan interest rate. So what Guardian does with all their products, and they've done this for a long time, is they will still pay a dividend on borrowed funds. However, it's going to match the loan interest rate. So if you've got an older Guardian policy where the loan rate is higher than the dividend rate, what ends up happening is when you borrow and repay, you see more cash value in the policy than what you would have otherwise seen. With this option, it's not the case. So the dividend rate with Guardian is again what? Dividend is at 5.65%. Loan rate is fixed at 5%. So on paper, that looks great. But when we drag it back down to reality, what happens here? You're not actually earning 5.65%. The IRR provides transparency there, but you are paying 5%. It's actually a little bit less than that. Guardian will apply a discounted rate of 4.76%. That's what he's actually paying here when we look at the numbers. If you pay the loan interest on the anniversary date. So that is nice. However, let's look at everything here. So, growth on the left. What does the policy look like if I don't touch it? Anytime we look at loans, I love looking at growth scenarios first so I can see the direct impact that it has on my policy. This is exactly what we looked at before. Then on the right, we've got the funding. That's great. But here's our loan coming out in year 3. Let's say I take $1 million out to buy a home. Okay, so $1 million comes out of the policy. What is the impact on the actual policy? If this is you, before loan, your cash value is 1.445. The net growth rate in year 3 is 0.23%. After loan, cash value is $434,000. Cost to borrow, 5. It's actually 4.76%. It's higher than 0.23%. However, interest is paid only on the loan balance while you continue to earn dividends and interest on your full cash value. Here's the catch though. A little different here with Guardian direct recognition. It is as follows. Dividend rate 565, that is gross, that's applied to anything remaining in cash value. Dividend rate still applied to the outstanding borrowed funds. 5%. That's less than 5.65%, which I know you know that, but it's less. So what will happen here? He borrowed. Now he's going to repay it. One thing real quick, look at the death benefit as well. You take $1 million out. Death benefits collateralized dollar for dollar. You'll always see that when you take loans. But here he repays it. So the interest comes due. This assumes he pays the interest out of pocket. And then next year applies $200,000 at the balance and continues to do that while he's paying the loan interest. So in purple are all loan associated payments, loan interest plus principal payments. When it is paid back, what do we notice here? Year 8, cash value, 3,943. How about over here? Year 8, cash value, 3,982. Difference in cash value is approximately $40,000. $40,000 less in cash value as a result of taking that loan and repaying it. His comment was that's minor relative to the policy size here. If he really did not like that, we would potentially pivot to another company. MassMutual's non-direct recognition, just as another option. Guardian also offers at policy year 10, you can switch to a variable loan interest rate, which makes the policy non-direct recognition. And all that means is when you borrow and repay, you'll see everything fully restored to exactly what it would have been as if you never touched it in the first place. Dividends are the same on borrowed funds and non-borrowed funds. But anyway, let's continue on here, because his questions and what we went through is what a lot of people have questions on. I want to see specific examples, not just hear about it. So same thing, we take a $2.5 million loan out. Look at this. What happens to your death benefit? Drops by about $2.5 million. Cash value, think of that as your equity, your line of credit. When you pull $2.5 million out down here, what happens? Well, it was 6.13, now 3.55. Repaid it, $300K per year. When it's paid back, what you notice here, pre-loan, if you never borrow against the policy, 10.25 versus here, just about 10. 250 grand. Like now we're starting to notice that it's $250,000. So in a case like this, what I would also look at, you've got a couple options. This is keeping the fixed loan interest rate, which he might want to keep, because when you hit retirement, if you want to begin to take income, what Guardian does is actually drop that fixed loan interest rate. It's fixed at 5%, meaning it will not change. And guess what happens? So fixed at 5, and then with this product, at age 65, drops to a fixed rate at 3.5%, which allows you really to pull out more income, especially when we look at the guarantees and a conservative dividend. So if someone wants to take an income stream from their cash value life insurance policy, locking in a lower fixed loan interest rate definitely helps, especially if we're conservative and we like to look at just, hey, kick the dividend rate down, let's look at things conservative. That's attractive there. But if he said, hey, income, like I've got enough cash in here regardless, I don't like this direct recognition, what are my options here? Because I do like Guardian in this particular case with the PUA flexibility and track record. Well, option 1, we could go with the fixed loan rate for the first 10 years, then flip it over to variable to go non-direct recognition, but then we're a variable loan interest rate. And one might say, I'm not comfortable with that either. And the other option would be as follows: flip it over to a cash value collateral loan, which at the time of shooting this video, they are still more attractive than direct policy loans with respect to rates. So here we go. If we look at this guy, we've got the growth on the left, annual and average IRR. Over here, cash value collateral loan, taking his policy to a bank, assigning the cash value as collateral to them, and getting a line of credit, just like a HELOC. So what we've got here, LTV 95%. Typically, whatever you have in cash value, you'll see with most banks and lenders, a 95% LTV. That's how much they'll grant you in the form of a line of credit. Available equity. So in the first year, we don't take any loans, so we can access all of our equity. Year 3, we took that $1 million loan. What happened here? Well, equity dropped by about $1 million. So we took $1 million out, and then he can take another $373,000 if he wanted to. If he dies here, what will happen is this death benefit, first the bank will recover their $1 million. So just like a direct policy loan, the death benefit would be used to pay off the loan here if we die while we have a collateral loan outstanding. We ran the interest rate at 4.25%. We can easily adjust this if we want. So interest comes due, he pays it, plus $200,000 in loan principal payments. Let me hit on something here. Year 3, what's his IRR, his net growth rate? 0.023%. What's his cost to borrow? 4.25%. What is he actually paying in loan interest? 42.5. What did the cash value actually grow by? We can sit there and crunch it with a calculator, or Exact same thing now. So in year 3, instead of an IRR, we've got a dollar amount here. That 0.23%, about $3,300 in gains. So what that means, right, the cash value growth is on the total cash value, is he earned $3,300 while he paid $42,500 negative that year. Make sure we're aware of that up front. Next year, let's assume we just pay interest only, $42,500. Cash value grew by $28,000. So that could be considered a low cost to a lot of people. And then by year 3 in this example, gains $54,000. This is isolating this particular year, $42,500. Why this is becoming more and more favorable is because remember the growth is on the entire cash value, whereas the interest here is only on the loan balance. So let's pay this back. There we go. So as we paid it back, $200K per year by year 8. Loans paid off, the total cost here in interest, $127,500. How much did you gain on the policy by year 8? Just by putting money into a cash value product. Total by year 8, $382. So cash value gain is the total gain. You can tell the first 4 years were negative, then gets better and better. Based on the present dividend rate, so we track this over time. And if we had a larger loan, right, let's say we had borrowed more and we paid more in loan interest, that might close that gap. But this is the kind of stuff we just like to look at with people. Whether it's a fit or not, our job is to educate around it, and then this way you feel like you make a transparent decision, not trying to figure it out on your own. Just make life easy for the consumer, in my opinion. But that's what we looked at there, just with direct policy loans, examining the IRR versus cost to borrow, and then also looking at it in dollar amounts. In this case, the 4.25% that will change over time, but if it doesn't, it would actually work out quite nicely here because eventually that IRR will exceed the 4.25%, which means he's got a positive spread no matter what. But if it goes up to 5 or so, or 5.5, then it's a little bit different. Then we see how much am I borrowing versus how much do I still have in cash value, and is it in my best interest, or do I see a negative hit there and maybe I want to do something else, or I still move forward with it because I view it as a low-cost loan. Everyone's different, and we just want to respect everyone's viewpoint there as well. Whiteboard went away. That's okay. Hope you enjoyed this video. If you did, please hit the like button, subscribe for more. If you have any questions, feel free to leave them in the comments below. I do check those out. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.